Usually when we look at the utility sector in a portfolio, the expectation is just utter predictability.
Oh, absolutely. Total snooze fest.
Right. I mean, you plug in a toaster, the element gets hot, the regional power company collects a fraction of a cent, and then, at the end of the quarter, they hand you this tiny, incredibly boring dividend.
Yeah, it's historically been that sleepy, predictable, kind of widow and orphan corner of the stock market.
Exactly. Slow, steady, and pretty much insulated from the kind of blistering technological disruption that we normally see over in Silicon Valley.
Well, I mean, that paradigm is entirely dead if you were looking at Constellation Energy in 2026.
Yeah, that sleepy clock is now basically strapped to a rocket ship.
It really is. We're analyzing a landscape that has violently pivoted from just basic grid maintenance to becoming the physical bottleneck for the entire global artificial intelligence revolution.
Which is wild to think about. So, welcome to this Talk Tickers deep dive. We are looking squarely at Constellation Energy Corporation, ticker symbol CEG, and we're unpacking their second quarter 2026 earnings call.
And our mission here is simple, right? We skip the fluff, translate all that Wall Street jargon, and just look at the cold, hard data to give you, the retail investor, some actionable insights.
Spot on. And just as a quick heads up for you listening, this is a story about the collision of the digital economies, like insatiable appetite for power with the stark physical limitations of our national grid.
Yeah, we are seeing one of the oldest forms of power generation, commercial nuclear fission, become literally the hottest, most fiercely guarded commodity on Wall Street.
Right. And the underlying mechanics of this quarter reveal a massive structural shift.
Definitely. I mean, we're moving away from these theoretical discussions about grid transition and looking at hard capital deployment. The numbers show corporate America aggressively attempting to secure its own baseload power, just bypassing traditional grid vulnerabilities altogether.
So let's look at the actual numbers they delivered, because the initial reaction to the headline data, it requires some immediate unpacking.
Yeah, hit me with the data.
Okay, so for Q2 2026, Constellation reported GAAP earnings of $1.42 per share.
Okay.
That is up 64 cents year over year, which, looks solid on the surface. But then management pointed to their adjusted operating earnings, which came in at $2.55 per share.
Wow. A spread of over $1 between GAAP and adjusted operating earnings is significant.
It's massive.
Right. And for anyone holding the stock, that adjusted $2.55 figure, that's the metric that actually signals the real health of the core generating assets.
I want to dig into that delta because a lot of surface level analysis just dismisses GAAP as, accounting noise.
Yeah, which is a mistake.
Right, because the actual mechanics of that noise tell a whole story about state-level energy policy. So the bulk of that $1.13 difference per share comes down to the Illinois ZEC program.
Ah, right, the zero emission credits.
Exactly. Constellation recognized $85 million of banked Illinois ZEC credits this quarter compared to $200 million in the exact same quarter last year.
Yeah, so the ZEC mechanism is it's this fascinating piece of financial engineering created by state legislatures.
Walk us through it. What exactly is a ZEC?
Well, a few years ago, states like Illinois and New York faced a huge crisis. Their climate legislation mandated massive reductions in carbon emissions, but dirt cheap natural gas was rendering their existing nuclear plants totally uneconomical.
Right, they couldn't compete on price.
Exactly. And if those nuclear plants retired prematurely, the states would just instantly lose gigawatts of baseload carbon-free power.
Which makes their climate goals mathematically impossible to achieve.
100% impossible. And just to be clear for the listener, we are strictly looking at the market impact of these laws.
Right.
We aren't taking any sides on whether state climate mandates are good or bad policy.
Right. Totally impartial here. We just care about how the rules of the game impact the balance sheet.
Exactly. So to keep the plants running, they created a state-level subsidy to essentially price in the clean attribute of the power.
Got it.
The state effectively pays Constellation a premium for the carbon-free nature of the generation, independent of the actual wholesale electricity price.
But what I find so interesting about this quarter's earnings is how the banking of these credits distorts the GAAP reporting.
Yeah, that distortion comes from the regulatory compliance periods. Under the Illinois Climate and Equitable Jobs Act, the state doesn't just, hand Constellation a flat check every single month.
Right. It's not a subscription service.
No, not at all. The volume of ZECs recognized depends on these really complex formulas tied to forward energy prices and also the specific retirement schedules of older fossil fuel plants in the region.
So Constellation can kind of bank these credits over a multi-year planning cycle.
Precisely. Which means the accounting department is recognizing the revenue based on the reconciliation of that multi-year compliance window.
Not based on how many megawatts the plant's actually churned out in Q2.
Exactly. CFO Shane Smith noted this was really just a final planning year adjustment before the current Illinois ZEC program transitions in May of 2027.
And that resulted in a $115 million year-over-year headwind on paper.
On paper being the key phrase there. It's a headwind completely divorced from the physical operation of the fleet.
I always like to use an analogy here for retail investors. It's kind of like checking your bank account on payday, right?
I like this. Go ahead.
So GAAP earnings are like looking at your checking account the second your paycheck hits, but before your mortgage payment is automatically deducted.
Right.
It might look like you have a ton of cash, or conversely, if a weird annual insurance premium just hit, it might look artificially low. But adjusted operating earnings, that's like knowing your true disposable income after all those one-time or lumpy annual expenses are smoothed out.
That is a perfect way to look at it. The cash generation capability of those Illinois plants didn't drop at all this quarter. The accounting timeline just shifted the recognition of that state-level environmental premium.
So when you strip out that $85 million true-up, you are left with the true disposable income of the core business, that $2.55 per share in adjusted operating earnings.
And that $2.55 figure was driven by higher capacity prices in the PJM interconnect and just a staggering level of operational efficiency from the nuclear fleet itself.
Let's transition to that, because these headline numbers don't happen by accident. They require serious operational muscle.
Oh, absolutely. Let's look at the physical machinery driving these financial results. In Q2, their nuclear fleet hit a 93% capacity factor.
And they churned out 40 terawatt hours of electricity.
Just for scale, 40 terawatt hours in a single quarter is enough to power millions of homes continuously.
That's insane.
It is. And that 93% capacity factor, that is the metric that institutional investors watch obsessively.
You know, I always look at that 93% and I wonder, why isn't a baseload asset hitting 99% or 100%?
Well, usually they're very close, but this quarter they had a brutally heavy maintenance schedule.
Right. They executed 6 planned refueling outages.
And a nuclear refueling outage is one of the most complex logistical ballet routines in heavy industry.
You can't just, pull a reactor offline for an afternoon like changing the oil in a car.
Definitely not. You have a massive, highly radioactive pressure vessel that must be safely depressurized, cooled, and then opened.
And the spent fuel assemblies, which have been bombarding water with neutrons for 18 to 24 months?
Yep, about that long. They must be carefully extracted and moved to the spent fuel pool.
And while the reactor is open, they aren't just changing the fuel, right?
No, they're doing massive capital upgrades that are physically impossible when the plant is running at full heat.
Vibration Unit 1 is a perfect example from this quarter. They didn't just refuel it, they executed a major high-pressure turbine upgrade.
Which is a massive undertaking. Replacing a high-pressure steam turbine involves coordinating thousands of temporary contractors.
We're talking boiler makers, pipe fitters, radiation protection technicians.
Exactly, all working in these tight, highly controlled shifts around the clock.
And what's the actual goal of that turbine upgrade?
The goal is to install new, aerodynamically superior turbine blades. These blades can extract slightly more kinetic energy from the exact same volume of steam.
So it increases the megawatt output of the plant without requiring a single extra ounce of uranium.
Yes, it is pure margin expansion. But honestly, the real story here is the speed.
Right. They completed these 6 outages, including that massive Byron upgrade, in an average of 23 days.
Which is just incredible. Dropping the outage duration by 40% compared to the industry average is a massive financial lever.
Because when a baseload nuclear plant goes offline for maintenance, Constellation doesn't just stop making money, right? They actively lose it.
Oh, they bleed cash. They still have commercial obligations to deliver power to their customers. If their own plant is offline, they have to buy replacement power on the open spot market to fulfill those contracts.
And buying on the spot market during a volatile pricing environment just completely destroys operating margins.
Every single day a reactor is offline costs the company millions of dollars in lost generation, revenue, and replacement power costs.
So shaving even a few days off an outage schedule falls directly to the bottom line.
Exactly. It requires militant discipline and project management. Constellation schedules these complex outages strictly during the shoulder seasons.
You mean like spring and fall?
Right, when grid demand is lowest because people aren't running heaters or air conditioners, and so spot market replacement power is relatively cheap.
And CEO Joe Dominguez really highlighted the payoff of that scheduling discipline during the call.
He did. Think back to that massive mid-Atlantic heat wave ahead of the 4th of July.
Oh yeah, when grid demand spiked and spot prices just surged.
Right. During that time, their fleet operated at a capacity factor above 99%.
Because they took the pain in April and May, so they could run full throttle and capture premium pricing in July.
It is the defining characteristic of a top-tier merchant generator.
But generation is really only half the equation here. The capital allocation strategy deployed this quarter is equally aggressive.
Very aggressive. Year to date, management has executed $2.2 billion in share repurchases.
Okay, I have to play devil's advocate on this aggressive buyback strategy because plowing $2.2 billion into share repurchases when the stock is trading near all-time highs, it feels incredibly risky.
I can see why you think that.
Right. I mean, if the AI data center boom ends up being a mirage, or if the hyperscalers just suddenly pull back on capital expenditures, Constellation basically just destroyed billions in shareholder value buying at the very top.
It's a fair concern.
Why not just issue a massive special dividend or, hold the cash for future acquisitions?
Well, the argument against buying at all-time highs assumes the market has already fully priced in the long-term value of the underlying assets.
And management doesn't think it has.
Not at all. Management is looking at their internal forward price curves for electricity, the scarcity of carbon-free baseload in the PJM market, and this massive incoming wave of long-term power purchase agreements.
So their models clearly indicate the intrinsic value of the business is far higher than the current market capitalization.
Exactly, even at these elevated levels. So they view retiring their own equity as the absolute highest return on invested capital available to them right now.
By shrinking the float, they mathematically force every remaining share to represent a larger claim on a rapidly expanding pool of free cash flow.
Yes. And it also serves as a really potent defensive mechanism against volatility.
How so?
A committed programmatic buyback of this magnitude provides a massive structural bid underneath the stock price. It sets a floor.
That makes sense. And to fund this, they are also pruning the portfolio, specifically getting rid of assets that don't fit the zero carbon thesis.
Right, like finalizing the sale of the Brazos Valley Energy Center to the private equity firm LS Power.
For $860 million. Let's dig into that because the mechanics of this specific transaction are vital for understanding the broader energy market.
They really are. So Brazos Valley is a combined cycle natural gas plant operating in the ERCOT market in Texas.
And Constellation was basically forced to divest this asset by the Department of Justice, right? For antitrust reasons stemming from their earlier Calpine transaction.
That's right, and bringing the total Calpine investment proceeds up to a staggering $5.9 billion.
Which is crazy because forced sellers usually get taken to the cleaners.
Oh, almost always. But LS Power paid an implied valuation of $1,420 per kilowatt for this plant.
Just for context for you listening, when Constellation bought into the Calpine fleet originally, the implied purchase price was roughly $960 per kilowatt.
So $1,420 is a staggering premium for a gas plant in a market that is currently being flooded with battery storage.
Yeah, why pay that premium? The ERCOT market dynamics explain it, right?
Absolutely.
Yeah.
Texas operates an energy-only market without a traditional capacity market.
Meaning generators only get paid for the actual electrons they produce, plus some scarcity pricing when the grid is severely stressed.
Right. And over the last 3 years, developers have dumped gigawatts of short-duration lithium-ion batteries onto the Texas grid.
Mostly to capture volatility during the evening solar ramp down, right? Yeah. When the sun sets, but AC units are still blasting.
Exactly. Batteries are great for shifting solar power a couple of hours, but they run dry fast.
I mean, if you have a multi-day winter freeze or a stagnant, windless heat dome that sits over Dallas for a week, those 2-hour batteries are entirely useless after the very first evening.
They're dead weight at that point. Right. So private equity firms like LS Power recognize that the massive influx of intermittent wind, solar, and short-duration storage actually increases the long-term terminal value of highly efficient dispatchable thermal generation.
Because a combined cycle gas plant like Brazos Valley can run continuously for weeks.
Precisely. As data center load explodes in Texas, and they require basically 99.99% uptime, the grid operators will be forced to rely heavily on these dispatchable gas assets to prevent systemic collapse during severe weather events.
So LS Power is willing to pay $1,420 per kilowatt because they are betting that the spark spread, which is the difference between the cost of natural gas and the wholesale price of electricity, will just blow out massively in their favor as grid constraints tighten over the next decade.
Yep. The fact that a sophisticated private equity buyer paid that premium in a currently soft ERCOT market completely validates Joe Dominguez's thesis.
Which is that existing physical generation assets are becoming exponentially more valuable.
Right, because building new plants and new transmission lines is practically impossible in the current regulatory environment.
Which perfectly sets up the pivot to their forward-looking growth engine, the power purchase agreement boom, or PPAs.
This is the really exciting part.
Constellation announced they signed 920 megawatts of long-term nuclear PPAs just this quarter.
And the headline transaction that grabbed everyone's attention was that massive deal with Wal-Mart.
Yeah, a traditional brick-and-mortar retailer securing direct, long-term nuclear baseload is a watershed moment for the energy sector.
It really is. For the past decade, the corporate ESG playbook was entirely focused on virtual PPAs for wind and solar.
Let's break down the mechanics of those virtual PPAs because they are essentially just financial derivatives, aren't they?
Pretty much. If a corporation wanted to claim they were 100% renewable, they would sign a contract for differences with a solar developer in, say, West Texas.
So the corporation guarantees the solar farm a fixed price for its power.
Right. And the solar farm sells the power to the local grid at the floating spot price.
And if the spot price is lower than the fixed guarantee, the corporation pays the difference.
And if it's higher, the solar farm pays the corporation.
But crucially, the corporation's actual retail stores or data centers aren't physically consuming those green electrons.
Exactly. They are just buying the financial attribute, the renewable energy certificate, to offset their carbon accounting.
Meanwhile, their physical facilities continue to draw standard fossil-heavy power from their local utilities.
Right. But the market is finally waking up to the physical reality that wind and solar are asynchronous to corporate demand.
Yeah, Wal-Mart has thousands of distribution centers and supercenters that run giant refrigeration units 24 hours a day.
And the financial gymnastics of a virtual solar PPA don't change the fact that when the sun sets, Wal-Mart's freezers are running on coal and natural gas.
So the push now is for true 24/7 carbon-free energy matching.
Corporations realize that if they want to physically decarbonize their operations every single hour of the day, they require baseload power.
And nuclear is really the only scalable asset that fits that profile.
It's the only one.
But how does the Wal-Mart deal actually settle? I mean, Wal-Mart has stores spread across dozens of different utility territories, but Constellation's nuclear plants are physically located in specific wholesale markets like PJM or NYSO.
Good question. The deal relies on retail supply integration.
Okay, unpack that.
Constellation isn't just a wholesale generator. They actually have a massive commercial retail business.
Oh, I see.
So they can take the physical generation from their nuclear fleet, package it with sophisticated load-shaping mechanisms, and deliver a retail power product to Wal-Mart's specific facilities within deregulated markets.
So they manage the basis risk, the price differential between where the power is generated and where it is consumed.
Exactly. Providing Wal-Mart with a fixed-price, carbon-free energy supply that perfectly matches their consumption profile.
That Wal-Mart deal really proves the demand for Constellation's product extends far beyond just the hyperscalers building AI data centers.
It does, but the data centers are still the main driver of the macro thesis.
Oh, for sure. And that brings us to the most contentious part of the earnings call, the stranded capacity debate.
This was fascinating. Joe Dominguez dedicated a significant portion of his prepared remarks to dismantling the prevailing narrative around grid constraints and AI power consumption.
Because the common industry assumption right now is that we must build thousands of miles of new high-voltage transmission lines and entirely new fleets of advanced nuclear reactors before we can deploy the next generation of AI supercomputers.
Right. Catastrophic strategic error that will just basically see global AI dominance to China.
See, I look at the rolling blackouts we've seen in California and Texas and the grid warnings in PJM, and it is really hard to reconcile that with Dominguez claiming the grid actually has massive amounts of unused capacity.
I know, it sounds counterintuitive, but the reconciliation lies in understanding the physics of grid design.
Okay.
The electrical grid operates without significant storage, right? Supply must perfectly match demand every millisecond. Consequently, the entire system, the wires, the transformers, the generation plants, it is all engineered to handle the absolute highest peak demand hour of the year.
I like to think of it like a human heart rate monitor. The grid is this cardiovascular system that has to be sized for an all-out maximal sprint.
Exactly, like 5:00 p.m. on the hottest Tuesday in August when every air conditioner in the state is running simultaneously.
But for the vast majority of the year, the grid is in a resting state. It has a basal metabolic rate that only utilizes a fraction of that cardiovascular capacity.
And that unused capacity during the resting state is what Dominguez calls stranded capacity.
Because for roughly 8,600 hours out of the 8,760 hours in a year, massive high-voltage transmission corridors and generation facilities are just sitting there, severely underutilized.
Exactly. And data centers, which draw a massive but completely flat continuous load, are the perfect customer to utilize that stranded capacity.
But the obvious problem is that a data center runs 24/7, meaning it will inevitably be drawing massive power during that handful of extreme peak hours when the grid is forced into a sprint.
Right.
So if the grid is already maxed out during a heat wave, adding a 1 gigawatt data center to the system will just trigger a total collapse.
And this is where Dominguez introduced a highly controversial regulatory solution regarding behind-the-meter, or BTM, generation.
Okay, what is BTM?
Well, every major hyperscale data center is built with massive on-site backup generation to prevent catastrophic data loss if the local utility fails.
Historically, these have been Tier 4 diesel generators, right? Though increasingly they are moving toward natural gas microgrids.
Right. So Dominguez proposes changing the regulatory framework, specifically Environmental Protection Agency rules, to allow these data centers to proactively disconnect from the public grid during those rare peak hours.
Wow. So instead of forcing the data center to curtail operations or drag down the public grid, the data center operator would just flip a switch, island their facility, and run entirely on their own backup generators for those few critical hours.
Exactly. It effectively removes a massive strain from the cardiovascular system right at the exact moment the system is maxing out.
So the public grid gets the headroom it needs to keep residential air conditioners running, and the AI training models don't miss a beat.
Yes. By maximizing the utilization of the grid's infrastructure for 99% of the year and islanding the data centers for the remaining 1%, you dramatically lower the per unit transmission and distribution costs for every residential and commercial ratepayer on the system.
That sounds brilliant, but the regulatory hurdles to implement this hybrid co-location model are immense.
They are. It isn't just the EPA rules on backup generator emissions. It is a massive jurisdictional fight between the Federal Energy Regulatory Commission, FERC, and regional operators like PJM over interconnection service agreements.
And again, to stay completely impartial here, the tension basically revolves around who pays for grid upgrades when a massive new load connects directly to a power plant, bypassing the transmission system.
Right. Utilities argue that co-located data centers are unfairly avoiding transmission tariffs, shifting the financial burden of maintaining the broader grid onto everyday consumers.
And FERC recently hosted a technical conference specifically to address these co-location issues, right? Demanding PJM explain their process for reviewing these arrangements.
Yes. And Dominguez noted that the regulatory ice is thawing much faster than Wall Street anticipated.
How so?
FERC is actively demanding new tariff rules that provide a standardized framework for these deals.
And the market impact of regulatory clarity just cannot be overstated.
Definitely not. Once FERC establishes a predictable framework for co-location tariffs, it completely de-risks billions of dollars in infrastructure investment.
And Constellation holds the prime physical real estate for this, large swaths of land directly adjacent to baseload nuclear plants with existing water rights and security perimeters.
It's the perfect setup. And the management team's confidence in navigating these regulatory waters is reflected directly in their financial forecasts.
Let's transition to that because the guidance updates completely recalibrated the market's expectations.
They really did. Constellation raised their full-year 2026 adjusted operating earnings guidance by 50 cents, establishing a new range of $11.50 to $12.50 per share.
And to contextualize this for you listening, the midpoint of this new guidance, $12 per share, was previously the absolute maximum ceiling of their best case scenario modeled just months ago.
Yeah, converting your best case ceiling into your base case expectation midway through the fiscal year, that indicates that they have locked in substantial commercial contracts and operational efficiencies that are totally insulated from macroeconomic volatility.
They also updated their 2029 capital allocation sensitivity range. Back in March, they provided a wide range of potential outcomes. Now they have established a hard floor of 20 cents per share in base earnings growth,
with an upside potential of 75 cents per share.
That 20-cent floor is just the mathematical consequence of the share repurchases we analyzed earlier, right?
Exactly. Because they have aggressively retired equity, the future earnings of the company will be distributed across a significantly smaller number of outstanding shares.
So that baseline accretion is already locked in. It is an irrevocable financial reality regardless of future power prices.
Right. And the 75-cent upside scenario assumes they execute the remaining $2.8 billion authorized under their buyback program, or pivot that capital into high-return growth projects if they materialize.
But the most powerful mechanism protecting these forward estimates is actually embedded deep in the federal tax code.
Yes. The Inflation Reduction Act fundamentally altered the risk profile of the merchant nuclear industry through Section 45U.
That's the Nuclear Production Tax Credit, or PTC.
Exactly. And again, neutrally speaking on the policy itself, this legislation acts as an ironclad insurance policy against a collapse in wholesale power markets.
The mechanics of Section 45U are crucial to understand. The government established a base gross receipts test.
Right. So if the market price Constellation receives for its power drops below a specific threshold, the federal government steps in and pays a tax credit to cover the difference,
ensuring the plant remains economically viable and doesn't shut down due to short-term market fluctuations.
It basically creates an artificial floor for Constellation's gross margins. And the brilliance of the legislation, from an investor's perspective, is the inflation adjustment mechanism.
Because the initial base price established by the IRA was $43.75 per megawatt hour.
Right. But during the call, CFO Shane Smith detailed the latest IRS inflation calculation.
Because of a 2.8% inflation adjustment for the 2025 tax year, the projected strike price for the year 2030 has been revised upward to $50.88 per megawatt hour.
A seemingly esoteric tax code adjustment that fundamentally alters the valuation models for the company.
As inflation runs through the broader economy, driving up labor and material costs for Constellation, the federal revenue floor automatically adjusts upward to compensate.
It is a federally guaranteed inflation hedge.
So even if natural gas prices completely collapse in 2030, driving wholesale electricity prices to the floor, Constellation is guaranteed to collect at least $50.88 for every single one of the tens of millions of megawatt hours their fleet produces.
Yeah, Smith estimated this specific inflation adjustment adds roughly 30 cents per share to their 2030 base earnings.
That downside protection really enables the aggressive commercial strategy we are seeing.
Definitely. Management can pursue these high-margin bespoke PPA structures with hyperscalers, fully confident that if the AI sector experiences a severe contraction, the baseline cash flow of the fleet is completely protected by the federal government.
And that dynamic extends to their approach to dormant assets, too. The discussion around restarting the Crane facility, which is historically known as 3 Mile Island Unit 1, it really highlights the total shift in public and political perception regarding nuclear power.
For sure. 3 Mile Island carries profound historical baggage due to the partial meltdown of Unit 2 in 1979.
Which essentially halted the expansion of the commercial nuclear industry in the United States for decades.
But Constellation owns Unit 1, which is an entirely separate reactor on the same site that operated safely and at incredibly high efficiency until 2019.
When it was prematurely shut down strictly due to economic pressure from cheap natural gas.
Right. The fact that Constellation is aggressively pursuing the restart of this facility and doing so with widespread political backing is just a stunning reversal of historical trends.
Though the engineering and regulatory hurdles to restart a dormant reactor are monumental.
Oh, massive. You are dealing with the Nuclear Regulatory Commission, an agency known for exhaustive, multi-year safety reviews.
The plant systems must be completely recertified, the workforce must be rebuilt and trained, and massive capital must be deployed to upgrade analog control systems to modern digital standards.
But management confirmed they recently received NRC approval for new fuel licensing at Crane.
Securing the specific uranium enrichment, whether standard, low-enriched uranium, or advanced HLEU, and getting the regulatory green light to bring it on site is a massive bottleneck cleared.
Huge. They are on a definitive trajectory to return gigawatts of generation capacity to the PJM grid by the second half of 2027.
And returning an existing, fully constructed gigawatt-scale reactor to service is infinitely faster and vastly more capital efficient than attempting to permit, finance, and construct a new, small modular reactor from scratch.
Completely. The immediate cash flow generation potential from a restarted TMI Unit 1 is immense, given current forward capacity prices in PJM.
So taking all of this into account, the gap versus adjusted earnings mechanics, the operational dominance of a 23-day outage schedule, the massive ERCOT asset premiums, the Wal-Mart PPA, the FERC co-location battles, and the federally guaranteed inflation hedges, we arrive at the core question for you, the retail investor.
What is the actionable takeaway from this quarter's data?
Right. What's the bottom line here?
Well, the synthesis of these data points generates an aggressively bullish signal for Constellation Energy. The fundamental risk-reward asymmetry is highly favorable for the equity holder.
Because the downside is capped by the massive share repurchase program and the inflation-adjusted nuclear production tax credit.
Exactly. The baseline cash flow is virtually guaranteed by the federal government and those state-level ZEC programs we talked about.
And the upside is effectively uncapped due to the unprecedented physical constraints of the national grid colliding with the exponential power demands of the artificial intelligence sector.
So if you're currently holding CEG, the data suggests this is a position to maintain. The management team is executing complex capital allocations flawlessly. The regulatory environment at FERC and PJM is moving rapidly toward accommodating their co-location strategy, and their core operations are vastly outperforming industry averages.
And for those evaluating an initial position, Constellation represents the premier infrastructure play on the digital economy.
Because the major technology firms, the hyperscalers, the semiconductor designers, they are all trading at extreme valuation multiples based on the anticipated future revenue of AI software applications.
You are paying a massive premium for the promise of future software disruption. But none of those software models can be trained, and none of those chips can function without continuous, massive inputs of reliable electricity.
Constellation allows you to invest directly in the critical physical bottleneck of the entire AI ecosystem, but you're acquiring that exposure at a much more rational valuation multiple, backstopped by physical hard assets and federal subsidies.
It is basically the ultimate pick-and-shovel investment for the current technological cycle.
You aren't attempting to pick which tech giant will win the AI software race.
Right.
You are simply providing the raw fuel that every single competitor is absolutely desperate to secure.
And that raw desperation for power is the most compelling theme to emerge from this quarter. We spent a lot of time analyzing the mechanics of the Wal-Mart power purchase agreement.
Right.
And, it is easy to view that as a one-off ESG transaction, but the implications are far more profound.
It really signals a fundamental loss of confidence in the capacity of the public grid to support modern corporate operations.
Which leads to a critical question to consider as you evaluate the macro environment.
Yeah, think about this.
If a traditional brick-and-mortar retailer like Wal-Mart is deploying significant capital and navigating complex wholesale power markets just to secure direct access to a nuclear reactor, what does that indicate about the future structure of the economy? It's a huge shift. How long will it be until every major Fortune 500 corporation realizes that relying on a congested, vulnerable, and increasingly unstable public transmission grid is an unacceptable operational risk?
We are rapidly approaching a paradigm where access to exclusive, guaranteed, carbon-free baseload power ceases to be an environmental talking point and becomes the ultimate competitive moat for any massive enterprise.
If Wal-Mart is taking the steps to construct a localized private energy reality today, the rest of the corporate ecosystem will be forced to follow tomorrow.
Absolutely.
Thank you for joining this Talk Tickers deep dive. We remain committed to stripping away the corporate fluff, dissecting the hard data, and delivering the mechanical realities behind the market's movements. Stay curious, keep interrogating the data, and we will catch you on the next deep dive.